Okay, you don't need me to tell you that you need to save for a rainy day. But looking at the US savings rate, maybe I do. Currently, Americans are spending more than they earn. And if you're one of them, it's not only bad for you, but bad for the economy. Really bad. You might be asking, wait, isn't spending good for the economy? Well, yes, if everyone drastically cuts back on spending, that can induce or exacerbate a recession. It leads to reduced output, or economic growth, better known to economists as GDP. And yes, that is indeed bad. But I urge you not to let that influence your personal savings and investment plan. There is no shortage of irresponsible people who will never learn how to budget their money, save for the future, and will live the rest of their lives paycheck to paycheck. One of the biggest contributing factors to income disparity comes from poor personal spending habits. By saving money, you're participating in the world of finance, either indirectly as a bank depositor or directly through investing in stocks and bonds. When you put money in the bank then lends out your money to business and industry, and they use that money to create growth in their industry, creating new technologies and new jobs and a new generation of savers. If the U.S. savings rate grows, so will long-term economic growth, and with GDP growth comes low unemployment and more opportunity. Part of the reason why this happens is because indirect finance is subject to the same law of supply and demand as anything else. The more savers there are, the more capital is available to business and industry, and banks will have to compete for their business. Competition leads to reduced finance costs and lower rates. Increased access to capital at lower cost equates to more economic growth, more jobs, more innovation and technology. These are all important factors in a long-term, stable, healthy economy. Economists summed up this effect in what is called an exogenous growth model. And this model is based carefully on examining historical data. They discovered a high savings rate finances technological growth that increases productivity and in the long run maximizes consumption. So by having a nation of savers, in the long run they will wind up having more of the goods and services they want in life, combined with financial security. You might ask, how is savings and investment related to technological growth? Take for example Leonardo da Vinci. He had many spectacular inventions. However, that didn't contribute to technological growth. Without a modern finance system, his inventions never had the opportunity to become part of daily life. Technology only skyrocketed after modern finance and banking was established. Without new business and industry to carry his inventions to market, they don't do anyone any good. And without modern finance, no new business and industry can emerge. And without savers and investors, there are no financial institutions. It all starts with savings and investment. During early times in many Western cultures, charging interest was illegal, which is why banking got off to a very slow start. The more savers there are today, the more technology advances tomorrow, both feeding into economic growth. Two prime examples of this are Japan and Germany post-World War II. Both the Japanese and Germans had extremely high personal savings rates after the war that financed business and industry and led to technological advancement. Two war-ravaged nations rapidly caught up to the U.S. standard of living. So what was it about the Germans and Japanese that led them to save so much? It certainly wasn't their DNA or culture. Can you think of more different people and cultures? Both Germany and Japan had tax policy that encouraged savings and investment. During the same time, U.S. tax policy discouraged savings and investment, and continues to do so today. I'll get into more detail on this with my video on tax policy, but briefly, the U.S. taxes the same dollar of income up to 4 times. You earn money from work, that's taxed. Then you take that money that has already been taxed and invest in some stock, and it pays you a dividend, and that dividend is taxed. Or if that stock appreciates in value and you sell it, that's capital gains, that's taxed too. And even though the company you're investing in has already paid its corporate tax and you already paid your income tax, the government taxes you again. Then, if you put money in the bank, the interest it earns is taxed again. Then, if you happen to die before your family can count on the security of your investments, it's taxed again through estate taxes. Estate taxes are especially devastating for small businesses, who often wind up going out of business or lay off workers when business ownership is passed from father to son or mother to daughter. Currently, the estate tax is 0% until 2010. However, Obama plans to increase it to 55%. How many businesses do you know that can withstand having half their value taxed? It's frustrating for your savings and investment plans. When you invest in the stock or bond market, there is a risk, and part of mitigating that risk is a higher return. But if the government taxes those returns, it makes it all the less worthwhile to even bother with. Same thing goes for saving in the bank. Most of the time you earn a very small amount of interest that barely keeps up with inflation, and then when the government comes along and taxes those earnings, you're at a loss. Might as well spend it now because it'll be worth less later is a very common attitude. Germany and Japan didn't have these egregious tax policies post-World War II. They became a nation of big savers, and the US became a nation of big spenders. So Germany and Japan were able to catch up to the US standard of living and had a much faster economic growth rate than the US. It's not DNA, it's not cultural, it's just tax policy. If you punish people for saving and investing, they'll do a lot less of it.